As we begin our journey in Chapter 2, you might already feel overwhelmed after all the material that we discussed in Chapter 1. However, don't fret. Everything will be okay. In the next several chapters, we're going to delve deeper into all of the various concepts we went through in Chapter 1. So hopefully, after we go through Chapter 2, you'll have a slightly better understanding of the financial statements we first discussed in Chapter 1, specifically the balance sheet. In Chapter 3, we'll continue our journey into the income statement, so hopefully that'll help clarify any questions you may still have. So the first thing we're going to talk about is understanding a business. So to understand the amounts appearing on the company's balance sheet, we need to know what types of business activities would cause changes in the balance sheet, how specific activities affect each balance that show up on the balance sheet, and how companies keep track of balance sheet amounts. So that's going to be the focus of this chapter. We're going to figure out what kind of transactions would impact balance sheet items. Remember, our balance sheet items are our assets, liabilities, and equities. So an example might be buying equipment. Buying equipment would affect the balance sheet because we would have equipment, which is an asset, and we'd be giving up cash, another asset, in order to purchase the equipment. So there'll be all sorts of different activities that we discuss that are going to impact our balance sheet. And then as we discuss those different activities, we're going to determine the impact that they'll have on the various accounts that show up on the balance sheet. Before we get to that point, though, we need to take a step back and focus on some fundamental vocab for accounting. The first and foremost is the overall objective of financial accounting, because if we don't understand our objective, there's no point in moving forward. The overall objective of financial accounting is to provide useful information to decision makers. That's the overall goal, to provide useful information to the decision makers. In order to achieve that goal, we need to have in place two fundamental qualitative characteristics, and that is relevance and faithful representation. Relevance means that the information matters, which also introduces a concept in accounting called materiality. Materiality is an amount big enough to make you change your decision. If we were in the classroom, I'd ask how many of you would stop on your way out of the classroom in order to pick up a dime. Not many people would raise their hands. Then we'd move up to a quarter. A few more hands would go up. Then we'd move up to $1, and almost everybody's hands would go up except for the few trust fund babies in the room. And then I would tell you, well, materiality means it's an amount big enough to get you to bend over. And the first time I explained it, a couple of people laughed, and then all of a sudden everybody started laughing, and I didn't really understand what I had done, and then I realized I'm talking about getting paid to bend over. And I saw the error of my ways, yet I still use the example because it really is a good demonstration of what materiality means. It's an amount big enough to get you to change your decision and bend over to pick up the money instead of just walking out. And that's what materiality is, an amount big enough to matter to the users in their decisions. So in order for information to be relevant, it has to be material. It has to be big enough to matter. Faithful representation, if we were in the classroom, again, I'd ask, what does it mean to be faithful? And not many hands go up, and I don't know if that's a college thing. Inability to determine what the word faithful means. But in a relationship, it means you'd be true to the person you're with. You wouldn't lie. You would be faithful to them, only be with them, etc. So in accounting, it means a similar thing. It means the information that we present is going to be true and accurate. It's not going to be deceitful. So it should make common sense that in order for information to be useful for decision making, it needs to matter. People have to care about it, and it needs to be faithfully represented. It needs to be truthful. It can't be a bunch of bullshit. It has to be truthful. In order to further enhance those qualitative characteristics, we have enhancing characteristics, which include comparability, which means we need to be able to compare companies from year to year. That's why we have GAAP in the rules that we follow, so every company is going to be presenting the information similarly. We need to have verifiability, which means we need to prove that it's faithfully represented. We need to be able to look at source documentation to determine that the amounts that are being reported are in fact true. It needs to be timely, which means we need to report the information as soon as possible. We can't wait a year to find out how a company is doing. We need to get constant information in order to make decisions. And then the last one you may disagree with, but the stuff is supposed to be understandable. And hopefully by the end of the semester, you'll at least be able to understand some of it in order to at least recognize when something doesn't look right, so you can have somebody else investigate it further if you don't want to pursue an accounting degree. There's one major constraint in all of this, and that's cost. It costs money to summarize all of this financial information, so we want to make sure that the cost of following the rules is less than the benefits derived from following them. And that all ties into the financial reporting standards, which we discussed are known as GAAP. So we want to make sure that the cost of applying GAAP is less than the benefits derived from the users of that financial information. Then there's some more vocab, which includes some assumptions which are covered in Chapter 2. The separate entity assumption means that the business activities need to be separate from the owners. Going concern means that the business is assumed to continue in the foreseeable future. In other words, we're not assuming it's going to go out of business. It'll continue for at least a year after the balance sheet date. Monetary unit just means that we can't use monopoly money in order to record the numbers. There has to be some stable monetary unit used, like US dollars or yen or euros. And then the time period assumption is that time is infinite, but we need to be able to break up time into smaller pieces in order to report on those pieces. So we prepare financial statements for a period of time, like a quarter, a month, a year, etc. Mixed attribute measurement is just the different ways we measure our assets. So we'll learn concepts like historical costs. We record our long-term assets at what we originally pay for them, which is known as historical cost. For some assets, we record them at the fair value, like investments. We would record them at the fair market value. So that's what mixed attribute measurement is. It's the way we measure our assets and liabilities, and we'll learn about that as we go through the chapters. Revenue recognition and expense recognition. I've already taught you this. You just didn't realize it. That's when we talked about revenues recorded when earned, not necessarily when cash changes hands, and expenses when used, not necessarily when paid. We'll talk more about that in Chapter 3. And then the concept of full disclosure. If you remember in Chapter 1, we talked about the notes being an integral part of the financial statements. So the concept of full disclosure is that we need to disclose all important information to the users, both in the financial statements and in the notes to those financial statements.